Welcome to the deep dive. You know, it's a really strange picture right now, isn't it? You look at the stock market, it's bouncing back, almost seems like it's celebrating something. But then you talk to people or look at the surveys, and there's still this deep worry. Things just don't feel quite right for many. It's like the financial news is telling one story, and, well, everyday life is telling a completely different one.
Absolutely. That's exactly what we're seeing. Key market indicators are definitely flashing some optimism, suggesting maybe some pressure's off. But then you look at consumer sentiment, how people actually feel.
Yeah.
That confidence just isn't there. It's a real puzzle, this disconnect. Definitely needs a closer look.
And it really feels like the main event, the thing that sort of flicked the switch for the markets, was this 90-day pause on tariffs between the U.S. and China, like a shot of adrenaline for investors, maybe?
That's a huge piece of it, yeah. The material we've looked at this week really highlights how pivotal that truce was. And it wasn't just about the immediate trade stuff. It signaled a potential shift, maybe, in the broader approach to policy, at least for these 90 days. It basically hit pause on what everyone saw as the most aggressive parts of the trade fight.
Okay, so let's get into the nuts and bolts then. What did this 90-day pause actually do for the markets? I mean, in practical terms.
Well, think of it like this. We had this period of, high uncertainty, lots of friction over trade. This truce offered a bit of breather, a moment where tensions dialed back. One source described it as creating a window of stability.
The window of stability, okay.
And that stability, according to the data we have, it unlocked risk appetite. Investors who maybe were sitting on the sidelines, feeling hesitant, suddenly they felt a bit more comfortable jumping back in.
And the numbers really show that, don't they? The S&P 500, the SPY tracker jumped, 2.6% for the week? That's pretty solid.
Very solid. And tech stocks were even stronger.
Yeah, tech went wild, up 6.6%. But it wasn't only tech, right? I saw consumer discretionary stuff people buy when they feel okay spending.
Exactly. Non-essentials.
And even utilities, which are usually seen as like safe bets.
Defensive plays, yeah.
They also had strong moves, especially on Thursday.
Precisely. That kind of broad movement across different sectors, it suggests a real shift in how investors are feeling overall. And it wasn't just buying. Look at the VIX, the volatility index.
Right, the fear gauge.
Yeah, basically. It dropped 4%, fell below 18. Our sources said volatility settled down, which, again, points to less immediate fear, less uncertainty among the big players.
So why? What was the thinking behind this positive reaction? Why did the truce make such a difference? What's the connection investors saw?
Well, what's interesting is how the market read it. It wasn't just seen as, 90 days off. It was interpreted as potentially a bigger shift in policy posture, like maybe a step back from just constantly escalating things.
Okay, a signal.
Exactly. And that was crucial because it helped deflate fears of a full-blown recession, which were definitely bubbling up. You combine that with some early signs that maybe inflation is softening a bit, and suddenly the outlook seemed brighter. That encouraged the big institutional investors, the big money, to come back, especially into tech, where future growth expectations are so important for valuations.
And we should probably mention Bitcoin too. It's been holding pretty steady around, $103,000?
Yeah, around that mark.
The info we saw suggested that continued buying, that accumulation there, could be seen as, a bullish sign, potentially.
Exactly. Even if the price isn't making huge leaps right now, that steady buying pressure, often from long-term holders, it can build a kind of foundation for future gains. It shows underlying conviction, even with all the other economic noise.
Okay, so picture painted. The market's breathing a sigh of relief, maybe getting back into riskier assets. But then, like you said, we look at everyday consumers, and it feels like we're talking about two different planets. Consumer sentiment at 50.8, described as one of the lowest readings ever recorded. That contrast is just, wow.
It's incredibly stark. It really highlights what one source called the disconnect, or a dual reality, strong markets, weak sentiment. It's a great phrase for it. Because while the economy might seem to be getting a breather on paper, thanks to the tariff pause, on the ground, as the source puts it, people still feel the pressure.
So while Wall Street's maybe seeing lower trade friction, potential for better profits, what are those pressures still hitting regular folks?
The sources consistently point to a few key things. First, just inflation fatigue. People are tired of everything costing so much persistently.
Yeah, that hasn't gone away.
Not at all. Then there's housing stress. High rents, mortgage is still expensive, affordability is a huge issue. And layered on top is political uncertainty. That just casts a shadow over how people feel about the future, their stability. These are real day-to-day things. A temporary tariff truce doesn't immediately fix your grocery bill or your rent payment.
It really does feel like the market is looking ahead, focused on potential upsides down the road. While consumers are stuck dealing with the here and now, the financial challenge is right in front of them. And one source even suggested this tension, this gap, might be the defining tension of 2025. That's quite a statement.
It really is, because it makes you ask, how long can this last? Can the market optimism eventually trickle down, lift consumer spirits, improve things tangibly? Or does this stubborn consumer unease pose a real risk? Could it eventually pull the market rally down?
So how can these two things exist at the same time? It seems contradictory. Markets up, people down.
Well, if you step back a bit, it starts to make more sense. Market sentiment is often driven by big institutional players, right? They're reacting fast to policy news, like the truce, and they're using complex models to predict future corporate earnings. It's forward-looking.
Okay.
Consumer sentiment, though, that's much more grounded in immediate lived experience. It's about the price of gas today, your rent this month, your job security right now. Those things don't always react instantly or even directly to something like a 90-day trade pause.
So for you listening, trying to make sense of this weird economic moment, what does this divergence mean? Should you trust the market's optimism or pay more attention to the consumer caution?
That's really the million-dollar question, isn't it? Look, the market optimism suggests a belief among investors that maybe some big headwinds are easing up, which could eventually lead to better conditions for everyone. That's the hope.
Right.
But the really low consumer sentiment is a powerful reminder that those improvements haven't actually landed for most people yet. There are still significant economic pressures out there. It just highlights that, different indicators tell different parts of the story. You need to look at a range of things to get the full picture.
So the big takeaway seems to be this really intriguing split. Markets are seeing green shoots, potential relief thanks to this tariff truce, while a lot of consumers are still just feeling the squeeze from high costs and general uncertainty. It really shows how one policy move can boost investor confidence pretty quickly.
Instantly, almost.
Even if the impact on people's daily finances isn't nearly as immediate or dramatic.
Exactly. And that leaves us with a final thought, something for you to mull over. How might this dual reality, this split-screen economy, influence your own financial thinking, your decisions, your view of things in the coming months? What signs will you be looking for? Will this gap between the market mood and the public mood start to close? Or will